Well, good afternoon, traders. It's been an interesting week, certainly for people looking at European assets. We've seen a bit of a more constructive feel towards the euro. Obviously, the ECB meeting has come and gone. We've been watching very closely what's happening in the German 2s 10s curve. That has flattened 7 basis points in the wake of the ECB meeting. Of course, European banks don't like that effect, but at the same time, we know that the ECB will do this QE infinity and keep asset purchases going at a rate of 20 billion euro a month. And I think one of the interesting situations, if you are trading euro dollar and euro crosses, is what's happening in the interest rate markets. Have a look at ONIA 1 year forwards. That had a decent move overnight in European trade. That went from negative 72 basis points, where the market was expecting more, and then moved up to negative 60 basis points. When we started seeing those rate pricings coming out of the market, euro dollar had a nice move up. And certainly Euro Swiss is something we're looking at this weekend. That looks reasonably constructive. If you can see this horizontal resistance level, if we can break through there, Euro Swiss could be an interesting trade. As we're seeing with Euro Yen as well, we saw the outside period there, but and certainly if that can build from there, Euro Yen would be an interesting trade as we go through the new week. But these ONIA rates at the moment have been moving up, and we've seen a decent correlation between ONIA forward rates and what we've been seeing in Euro Swiss. That's definitely something we're going to be watching going forward. If we have a look at the price table, though, in the wake of everything we've been seeing, it's been the pound that's been the superstar in G10 throughout this week, as you can see from the price table. And these are currencies traded against the US dollar. Sterling dollars or cables rallied 40 basis points on the week there. It's actually sterling yen which has been the best performing currency. That's had a move of about 1.6% over the last 5 days. If you actually have a look at cable vols and have a look at 2-month implied volatility in cable, that's really come off quite sharply. It's come off from a high of 16.12 or 16, just over 16%, down to current levels around 9.35%. So certainly people have been selling volatility, and things are looking obviously a lot more constructive in the UK. The new news that we're seeing now is that the DUP party in Ireland, in Northern Ireland, may be looking to abide by some of the EU rules post-Brexit in a deal to effectively remove the backstop or replace the backstop. So that's certainly looking a bit more constructive at a time when Boris Johnson will have to apply for an extension. The question, of course, is whether the EU would grant them the extensions. If it looks like the DUP party may actually come and throw Boris Johnson a lifeline and potentially a deal, that could be very constructive for the pound going forward, and certainly people have been buying in that wake as well. As you can see here, we've been seeing a better feel towards the euro, but the US dollar still remains fairly firm across and fairly mixed on the week there. So what we're looking for the week ahead, well, I think let's start with what's happening in the interest rate markets and what's being priced. And you can see from this table straight away that if we go through these, you can see that the RBA, there's a 25.8% chance that we get a rate cut at the coming meeting. This second to right column effectively shows the probability of a rate cut coming in the upcoming meeting. So in terms of Australia, we've got a pretty low chance that we're going to get a rate cut in the October meeting. It's a bigger probability if we go into November, and we've got 43 basis points of cuts being priced in over the coming 12 months, so just under 2 rate cuts. This is the dynamic that we're facing in the rates market, and of course effects will be leveraged to that as well. If you have a look at the Fed meeting, which we'll discuss in a moment, there's a 100% probability that we're going to get a rate cut coming through at that meeting, and then we'll go further out the curve over 12 months. We've got about 81 basis points being priced in. In fact, in the US, if you look at the end of the year into December, we've got about 51 basis points, and that's something that we'll have to discuss with the Federal Reserve. If they cut, if they don't cut, will they meet the market pricing going forward? The ECB, even though we had that 10 basis point cuts to the deposit rate down to negative 50, the market's actually seeing a 68.4% chance that we get another rate cut in the deposit structure as well. In New Zealand, you can see there's only an 8% chance. The UK, there's very low chance of the next meeting. So it's really what we're seeing is that the ECB, the market's saying on balance, they probably see a further deposit rate cut down to negative 60, and that's the structure we're working in. But in terms of actually the longer term credentials, you can see that the market's still implying fairly aggressive cuts from these various central banks, but that has come off. There has been some changes in that rate dynamic. Some of the rate cuts over a longer term period have been coming out. A lot of that, of course, is down to this better feel that we're seeing towards trade. Donald Trump saying that he's entertaining the idea of an interim trade deal, although he'd prefer a whole deal. And there's also a lot of talk about China buying agricultural products from the US, something that Donald Trump would obviously enjoy. But the question is around that, what sort of level are we going to be seeing in terms of those agricultural product purchases? That's the devil that's in the detail. What was the size and the scope of that agricultural purchases if we see that. One of the things that we have been seeing, of course, has been a much stronger bid in equity markets. As we go into the 70th anniversary of the People's Republic of China, we are seeing a bit of a melt up in things like the Hang Seng, which has benefited from some better feel around the news flow there as well, around the protests. And of course, we've been seeing in the CSI 300 and also the A50, the Chinese markets there, the mainland markets, that there has been a bit of a better feel. There's obviously been better liquidity coming through with changes that have been happening in reserve ratio requirements. We're looking whether we're going to see changes in the medium lending facility, and again that could be positive for risk assets. Certainly retail traders on the ground, which make up about 80% of the flow of the Shanghai Composite and the CSI 300, will be seen a sort of a quasi signal to get involved in those markets as well. So something we are watching there. Now, in terms of what's going to drive us for the week, well, of course, it's really going to be going into Thursday morning at 4 a.m. or Wednesday night for European traders and US traders is the FOMC meeting. The interesting situation is that, as I said, that the market has fully discounted a 25 basis point cut. In fact, really since the beginning of August, we've seen a situation where the swaps market, the rates market, have been pricing in 100% chance of a rate cut or even slightly more since the 2nd of August. And the issue for me is that we just recently saw Jerome Powell speaking in Zurich. He had every opportunity, knowing that he was the last speaker before the blackout period, to come and infiltrate the market. And he hasn't changed that dynamic at all. He didn't re-guide the market at all. He didn't guide to a 50 basis point cut. He didn't guide away from a 25 basis point cut. So in my opinion, we are going to see a 25 basis point cut. We're going to see probably two dissenters, Esther George and Eric Rosengren. And we're going to have a look at the dot plot projections as well, just to probably have a look over the next year or two, just how many people are looking for lower rates and where those rates are going as well. The argument, of course, is what's happening over the course of the year. So I think we'll see a 25 basis point cut. Will they meet the market pricing that they're expecting to see another rate cut from the Federal Reserve this year? Will Jerome Powell still continue to believe that we're in this mid-economic cycle? And the dynamic that we're facing in the US is that manufacturing is very weak. We've seen capex numbers falling, and we've seen trade volumes globally under some pressure as well. But on the other side, the service sector looks pretty good in the US. You can see very strong consumer confidence numbers on the CB board. The University of Michigan, not so great. And the labour market continues to look pretty good, although we did obviously see that slightly weaker headline non-farm payrolls number. But there was some good factors in there. So I think we do get that. We do get the 25 basis point cut. And the other thing is as well, if you have a look at implied volatility in dollar yen, have a look at my implied volatility chart here. You can see the at the money implied volatility, and you can look at dollar yen, for example, which of course is a really good proxy of how the Fed's probably going to trade. It's going to be very closely aligned to what's happening in the yield complex, certainly in rates, and you can see dollar yen there, the implied volatility at 7.6%, which, to give some context of where that level of implied volatility has been over the last 12 months, that sits in the 42nd percentile. So it's not particularly high. This is a weekly implied volatility, so we'll cover the Fed meeting. And again, if we can put that into the straddle, that will effectively give us the market saying that on balance, they see with a 68.2% level of confidence, dollar yen trading up or down by about 85 points throughout the week. That's what the straddle's pricing. So again, you can see there in terms of what we're pricing in dollar yen, the market sees probably prices contained up to 109.12 and down to 107.18. Again, volatility doesn't give you a direction, it just tells you the extent of the move we've been seeing there. Going to China, of course, everyone's continuing to watch what's happening in any kind of headlines around trade. We're watching very closely what's happening in dollar CNH. If that makes a continued move down to the 7 handle, you're probably likely to see Australian dollar pushing back above where we are at the moment, around sort of 69 cents. If you have a look at implied volatility in dollar CNH, it's at 5.17, one of the lowest you can see there, 29 percentile. So certainly people have been sellers of volatility there. Aussie dollar, you can see at 7.8%. That's the 39th percentile. So there's been a broad selling of volatility in FX, as we've been seeing in equity markets as well, where the VIX index is trading at 14.2, which again is the 13th percentile. So very low or relatively low implied volatility in the S&P, and the market there potentially breaking out to new all-time highs. I wouldn't be surprised if we see next week new all-time highs in the S&P, Nasdaq, and also the Dow. We've been seeing outperformance from the small caps, the Russell, so it's again something we're going to be watching. Will we see a quality journey in the S&P with cyclicals outperforming defensives, low beta, underperforming high beta, and also the small cap index continuing to outperform the large caps? So it's something we're watching, but certainly at the moment you wouldn't be betting against that. I'd continue to trade with a trend in that situation and look to fade longer term. In Australia, though, we go back to what's happening in dollar CNH. I think Aussie dollar will continue to follow that very closely. But I think you'll be keeping an eye very closely, as I say, on what's happening in the employment numbers there. So the employment numbers in Australia come out on Thursday. The market's looking for 20,000 jobs. They're looking for that unemployment rate to stay at 5.2%. Again, we're not expecting fireworks. The volatility structures are saying, we're not expecting anything too punchy there. And if you have a look at risk reversals on this chart here, you can see in terms of Aussie dollar volatility that the skew there is at negative 52, which is around the 64th percentile. So in terms of the way that the market's structured, there's still bigger sellers of volatility on the downside than they are on the upside. So it's a slightly defensive position market. The market's saying on balance that the downside risk still playing through in the Aussie dollar in terms of the options market. Definitely something to watch. In the UK, it's all around the Brexit headlines. That continues to be the main driver, and it will be going forward. As I say, people have been selling volatility in sterling, and cable looks more constructive at the moment. There's obviously been a nice melt up of all the news that we've been seeing. The market has reduced some of its short positions. You can see here the commitment of traders report that tells you the positions. The market's still short, and of course, you are going to be getting a situation where that will be refreshed overnight in the coming trade. But inflation numbers coming in the UK, will that really matter with all the headlines we've been seeing? You might get a little bit of a move there that comes in there, but nothing too sinister. In Europe, a couple of things we're watching. It continues to be driven by ONIA rates and what's happening in the yield curve structure. The banking sector is one we're watching. We get ZEW confidence numbers coming through. They'll be interesting to see if there's any kind of rebound after a pretty disastrous number that we saw in September at negative 43. And we also get European CPI numbers. What I am watching in Europe, and I think that's really interesting, is what's happening in inflation expectations. If you have a look at Europe, five-year inflation swaps, they have moved up to 130, and that will be something that Mario Draghi will be very happy about as he hands over to Christine Lagarde, that we have started to see inflation expectations moving up a little bit. It's early days, but something that they want to infiltrate. To create inflation is this idea of inflation, higher inflation expectations, and that could be something that will be driver of Euro Yen, Euro Swiss, and the Euro pairs as well. So certainly something we're watching. Clearly the Fed meeting is going to be the driver. Volatilities have been falling, equity markets have been rallying, and we're set the stage for the new week.